The father of modern portfolio theory said the only free lunch in investing is diversification. Let's talk more about that in this edition of the Video Market Update. When we think diversification, I think we think, let's not put all of our eggs in one basket. And that in an investing sense is true. Why diversification? So look at this chart and it shows asset class performance by decade going back to the 1930s. And what you will see is, yes, stocks have been the dominant performer, but there have been decades in which gold was a better performer or real estate was a better performer. Now, it's important to note this is by decade, not by year. Certainly, if you bought real estate in the early 2000s and sold out in 2007, you would have made a lot of money. If you held it to the end of the decade, you would have lost a lot of money. The same can be held true of other kind of more unique or special situation investments. So let's break down specifically in stocks, let's break down year by year. And I'll put up the Skittle chart and it'll fill up the screen of the different investment and asset classes per year. You'll see there are years in which international has performed well, large cap stocks, mid cap, small cap, bonds, real estate investment trust. There's even a year in 2018 where the best investment to hold was cash. Think about that. Now, oftentimes you hear, well, I'm diversified. I have 20 different stocks or 30 different stocks. Right now, we're in a situation where valuations are high and there is less diversification because so much of the market is holding 7 funds. There's been numbers that show between the S&P, the Dow, the NASDAQ, and the Russell's 3000 that somewhere between 40 to 60% of the companies are down for the year, but have been held up by some of these larger tech firms that have done so well. So how do we diversify and why do we diversify? Well, why we diversify is to try to spread risk amongst different asset classes. If you look at the S&P 500 this year, we're up, this is early November, we're up about 12 or 13%. Look at international, it's up about 25%. Look at gold, it's up over 50%. So those are somewhat non-correlated to the US market. Real estate historically has been a good investment, but boy, it's expensive to buy. Fixed income and some fixed income investments that some of you who are closing in on retirement have invested in that maybe younger clients have not invested in because you have something that is precious, which is time. But as you get closer to that retirement date, you do want to have broader diversification because when I think, there's some turmoil in the market, we've seen it with all of the issues around tariffs, will they, won't they remain, interest rates going up, going down, a lot of the political instability around shutdowns. I do think there's a slowdown coming. Now, is that in the next 1 to 3 years? We don't know, but we need to be properly diversified. Some people are 100% in stocks. Some people have 40% stocks and 60% fixed income. Some are 60-40 traditionalists. Some are 70-30. That's why it's important to have an asset allocation and a diversification that works right for you. Maybe it's not what works for your neighbor or your friend down the street, but it works best for you. And that's what we try to do, is to set up those diversification buckets so that we provide accurate diversification. So again, with the choppy market, we're seeing 4 and 5 days of down markets, it's important to go back to the fundamentals and try to get that free lunch, which is diversification. So if you have any questions on this or anything you're seeing in the market, let me know. But if not, as always, I hope you make it a great week.